You're listening to the Reinvest Podcast, where each Tuesday we show business owners and entrepreneurs how to reclaim, reconnect, and refocus their life by bringing you the top real estate professionals in the industry. We'll help you diversify into real estate by equipping you with the tools and tactics to build generational wealth. Your hosts, Garrett Gatton and Seth Ciminillo. Hey, Reinvest listeners, thank you for joining into another episode of the Reinvest Podcast 101. We've got an exciting episode today. Being from a small tertiary market in Northwest Ohio, tucked into the Midwest, there is one concept in real estate investing that we understand very well, and that is cash flow. I remember starting out in real estate, and you'd see all these guys on the East Coast, West Coast buying in the Sun Belt, right? Circa 2019, and they're playing the equity game.
And I didn't even know. I quite honestly did not understand that. I did not even know that was a thing to buy something without cash flow.
That didn't cash flow
I didn't understand
for the hopes that you would make, big upside, in 3 to 5 years. So I, ashamedly didn't understand that as a strategy. All we've known is cash flow, cash flow, cash flow. So today with us is going to be a suiting topic, and we've got Kevin Bupp with us. Kevin, how you doing, man?
Fellas, I'm doing great. I appreciate you having me. I'm excited to be here.
If someone's watching on YouTube,
cash flow is the key.
That's right. Cash flow is king. And behind you, if someone's watching on YouTube, Kevin, Sunrise Capital Investments, that's your investment company. But you're also a podcast host as well. Tell us a little bit about what you do.
Yeah, sure thing. So I launched my primary podcast, Real Estate Investing for Cash Flow, back in January of 2014. And, I started listening to podcasts many years before that, when not many people even knew what a podcast was. The funny thing is, when I launched the show, a lot of the interviews I would have, like in the commercial real estate world, which is what we focus on, it's a lot of it was just a really good old boys network. And so there was a lot of folks I'd bring on the show that were maybe like in their 60s, 70s. Mm-hmm. Right. And I would say a good half of them didn't even know what a podcast was. And so I would just have to simply state, it's an internet radio show. That's what it is.
Right.
For them to actually understand that, the funny thing is, after we would record it, they wouldn't even know. I mean, we would send them links and things like that, or to their assistant, but they literally wouldn't even know how to listen to it, right? Unless they went to the website and where we hosted. So it's kind of funny, but I started the show, primarily because back then there weren't nearly as many shows there are today. There was a couple that were on topics I wanted to learn about, but most of the real estate stuff out there back then was like fix and flip, wholesaling. And again, even then there weren't that many real estate podcasts. And so I started because it didn't exist. And I figured, as though if there's a lot of topics I want to talk about and learn about, and folks I want to interview, there's probably plenty of other people out there that want to, listen to the same thing and learn the same things. And that, if all that happened was I get to have cool interviews, and maybe there's 10 or 12 people that tune in and listen to it, right, then we're all winning, right? And so it's turned into something much bigger than that. I've had a lot of fun doing it, and I met some incredible people along the way. So, that's as far as the podcast. As far as the other piece of it, Sunrise Capital Investors, that's the name of the company. I'm one of two principals. We founded that back in 2014, but I've been a full-time real estate investor. I bought my first property when I was 20 years old. Got introduced to real estate when I was 19. Ended up working underneath the wings of who became my mentor. His name was David. He was a local real estate investor in my hometown of Harrisburg, Pennsylvania, and just learned the ropes. Attended bar in the evenings. Went to a local community college, not really knowing what I wanted to do with my life, but just took classes because that's what I was supposed to do. And by happenstance, through a girl I was dating, met this guy David, who was dating her father, or dating her mother, and long story short, I just went to work for him for free for like a year, a little bit more than a year, and in between tending bar in the evenings and classes 3 days a week, I would be helping him wherever he needed help, literally dropping leases off, picking them up, going to Home Depot, picking up 2x4s, dropping off at one of the houses he was.
Why?
Just so I could learn the business. I wanted to learn. I grew up in a very, middle-class family, never went without. I mean, went on one family vacation a year. It was a good upbringing. Again, we weren't poor, we weren't rich, but surely there's always money struggles. Both my parents worked. I remember when I was a lot younger, my mom worked literally like third shift because we couldn't afford, childcare. It was all relative. I didn't know we didn't know any different. I just knew that when my dad came home from work, they had a little bit of time together, and she went to work, right? And then she would come home early in the morning, and then he would leave for work, but there was we didn't have a babysitter. We couldn't really afford a babysitter. So they did that in order to provide for my brother and I. But I guess, as I got a little older, and then when I ran into David, or met David, he just seemingly lived a very different lifestyle than what I was used to. I mean, just he dressed differently. I didn't know any business owners. I didn't know that world. It didn't make any, it just, it was never presented to me. I was never exposed to it. And so when I met David, number one, seemingly had a lot of flexibility in his lifestyle, drove really nice cars. Back at that age, at least more so than today, and material things were pretty important to me. Like that was like, wow, like this guy's got like this, sports car, and he's got this cool SUV, and he kind of he seems to be around when other folks his age should be working, at their jobs, and it just very different than what I was used to. So that was intriguing to me because at that age, I didn't know what I wanted to do, but I knew I wanted to make money. I just didn't know how. I wasn't really into just the general academic thing. Like I was going to school, going through the motions, but I had no heck of what I was going to apply it to. And so this became
interesting
an opportunity.
How knowledge is power. Like I think back to some of where like 5 years ago, I got started in real estate, knew nothing about real estate, got brought on my horizon, and you're kind of immersed into this underground world that was not on your radar at all.
Right.
That's right.
And by acting on that and being exposed to that knowledge and taking action on it, even in small incremental ways. Like I wish I could tell you that the first time I heard about real estate, I was like Grant Cardone and I went heavy in on it. I didn't understand even the power that was in front of me. And I just kind of like haphazardly took steps forward, and then after doing it for a little while, I was like, wait a minute, this is really powerful. So it's interesting though, how you were exposed to it and that set you on a trajectory.
That's right. Absolutely. And that was it. I mean, that's literally been it for my entire, adult life. I'm 45 today. I bought that first investment property after about 14 months of working with David and just listening to him talk to sellers, listening to talk to buyers, to tenants, to contractors, to realtors. He would do like his own marketing, and so people would call him, like he did like the We Buy Houses thing to find properties, and I would listen to him negotiate, and just after listening to that for over a year, going to investment club meetings with him and getting to meet kind of his expanded network, private lenders, and just understand the basics of what it was he was doing and how he was doing it and how he was making money, and really seeing the opportunity, kind of putting all the pieces of the puzzle together and realizing that this is something that I definitely could do. And a lot of folks I met, maybe they had more specific knowledge, but they weren't smarter than I. It's kind of how I felt. I'm like, look, they just know a little bit more. They've been exposed to it for a longer period of time. But I don't feel like a lot of these folks I've been meeting that are doing quite well are smarter than me. I just need to learn more. So like that was kind of the catalyst to me really wanting to go work for David, like just truly say like, hey, but man, whatever you need, I'm here to help you, but please in turn, let me learn from you. And so again, it's funny because my friends made fun of me at that point. They're like, why are you hanging out with this old guy all the time? Because he was like 25. I mean, he was as old as my parents. And they thought it was kind of weird. And I'm like, they were like, come out tonight. I'm like, nah, man, I got to go, spend some time, help Dave with this project or whatever. And they're like, dude, what are you doing, man? Like, just so weird. Like, you're 19. Like, come on, like, we're going out and partying or whatever. And and I wanted to go hang out with the old guys. Is how they looked at it. And fast forward, it was a good choice. That I made back then.
So he was doing residential real estate and flips and buy and hold rentals and stuff like that.
He mostly was his primary business. Now again, he was doing it for 30 plus years, right? So he was way further ahead than what I was. But so his primary business when I met him was buy and hold. Like he was a cash flow investor. Mostly single family, some smaller multifamily stuff. But that was his MO, to buy and hold. He would do cash out refinances whenever the opportunity arose, and take out cash and then go buy another property, and basically just recycle that capital over and over and over again, and basically let his tenants pay down his mortgage. I mean, that was his business model. It was very simple, very straightforward. And so, I don't like reinventing wheels, and I basically just took what he was doing and tried to replicate it myself. However, I did run into one hiccup after buying that first property, and I very quickly realized, I'd saved up about $7,000 bartending. I bought the first property by using that $7,000 plus one of his private lenders helped fund the deal and helped to fund the rehab costs. And I turned around and rented that property out. And I learned very quickly that $250 or so of positive cash flow a month, it was going to take me a very long time to save up enough money to go buy another deal. And so I slightly morphed my business model into more of I became really good at the marketing side of things. And so ultimately I started wholesaling. I'd wholesale 2 or 3 and then keep one, wholesale 2 or 3, keep one. In fact, I wholesaled a number of homes to David, right? And then he had an immediate network, and I was already kind of plugged in. And so I just realized, I figured out what other folks were looking for, and I became really good at going to find it. And that really good at finding great opportunities at below market value has just really played out through my entire career. Like that's where I really shine, is like, the hunt of the deal, and actually, structuring a deal that is a big win on the front end going in, right? You make your money on the buy. And so that's what I did. I did that for many years, built up a pretty big portfolio of single family properties in my early to mid 20s. Started buying multifamily along the way, and then got introduced to commercial real estate leading into like '08. And then '08 was a challenging time. Had about 3 years of just distress and just challenges and more defensive mode than anything else. But ultimately was able to kind of rebuild things starting in 2011. And I started rebuilding with mobile home parks. I'd never invested in parks before. I was introduced to parks back in 2011, bought that first one up in Atlanta. It was a REO. Back then, everything was distressed. Bought that, turned it around, bought the second, bought the third. Now we've done, I think we bought over 45 different mobile home parks in a dozen plus states.
Wow.
And it's been a great asset. And I just tried to condense it like 20 years. There's a lot in there. I've owned mostly every type of commercial real estate. I've owned, and I still own today, self-storage, medical office, industrial. I like a lot of other asset, multifamily. I love a lot of the other asset classes, but we always try to stay focused. And so when I came into mobile home parks and learned the opportunity there. And back then there wasn't as much competition. We just went all in, and we really had a hyper focus on that niche, and literally had a very strong hyper focus up until I guess you could say 2020 is when we actually added one other vertical to our investment business, which is parking investments. So parking lots and parking garages. But up until that point, I mean, literally, a decade plus, it was just hyper focused on mobile home parks. Go all in, go deep, and be the best we can be in that asset class. So
interesting. So, kind of as you were walking through that scenario and kind of that 20 years condensed into like 3 minutes, a lot of the guys, first I want to comment, David, your mentor, what's crazy about real estate is you can, even if you are just going to do that model of buying 1 or 2 properties a year and doing that for 10 to 15 years, you will be successful. I mean,
absolutely.
The bar for finding success in real estate is actually pretty low. It just takes time and consistency and fundamentals like anything. But we're going to get into is a little bit, you're talking about doing this at scale. You started to kind of surpass and go on to some bigger properties, some bigger investments. Kind of crazy that 08, 09, and the difficulties there didn't scare you away from real estate altogether. Right, I mean that's what I'm.
It did for a couple of years. It kicked my butt, but not
that's
forever.
You didn't just drop it and leave it. I'm sure there was a lot of people that left the industry and went and said, "I'm never investing in real estate again. This is a bad investment vehicle." Yeah. But you jumped back in and you came in at the bottom of the market, and you were a buyer in the bottom of the market. So let's talk about this idea of, and you see this a lot. People use this term velocity of capital, recycling capital. One of the big things that you'll talk about is long-term buy and hold cash flow investing. What, do those things, are they the same? Are they different? What are your thoughts on those two philosophies of investing?
Yeah, well, I mean, there's definitely there's an argument on both sides of the camp, and don't get me wrong, we do sell assets, we do recycle capital. However, the other side of that argument, as far as like holding assets for a very, very long period of time, is really, it's specific to not just mobile home parks, but parking, because both those asset classes, they're not building. There's no new supply coming into the marketplace. In fact, both those asset classes have a diminishing supply. And so when we look at mobile home parks, and when we find assets that are in great markets that have strong demand for affordable housing, we know that new ones are not being built down the road. And so there's a massive barrier to entry there. And we know that it's inherently getting more difficult because there's more of a demand for this product. It's because 10 years ago, 12 years ago, it wasn't sexy. Institutional investors weren't interested in buying it. Right. There wasn't a lot of competition. People didn't talk about it. Kind of, if you knew, you knew. If you didn't, you didn't. Right? It was like just the secret network, which pros and cons of of why I wish it would have stayed. But I'm happy that there's institutional capital into it now. There's definitely a good and bad to that. But long story short is that it's very difficult to replace these assets. And so if you find a great asset that cash flows well, and it's an incredible market, and there's a barrier to entry to build new, it's like every time you sell, you've got to go find something else to buy. It becomes inherently more difficult to recycle that capital. And on top of that, you create a tax event every time you do that. And I know it's great to make huge returns, and the shorter duration, you can really run those IRRs up. And if that's the focus of your investment group, and that's what they want, and they're only focused on IRRs and not focused on equity multiples, then maybe that's the right business model for you. But for us, we know that these are irreplaceable assets, and we know that they're going to continue to increase in value over time. And again, we know that there's going to continually be a barrier to entry there in that marketplace. And we know that we can avoid that continual tax event that you have when selling by doing cash out refinances. I mean, the opportunity to do tax-free cash out refinances every 5, 7, 10 years, whatever that time horizon looks like, allows you to achieve a lot of those same things of getting your investor capital back to them, recycling capital, putting into other deals, but you don't necessarily have to sell the asset that is going to be very difficult to replace. And so that's why we're really gun-ho on that strategy of just really holding for a long term and leveraging it to build long-term wealth for our investors. And the same thing applies with parking assets. There's a parking moratorium in a lot of cities across the country. Like if you tried to go in and say, hey, I want to knock down this building and build a surface parking lot out of it, or I want to build a new standalone parking garage. I'm not going to say it doesn't exist, but it's very few and far between. In fact, a lot of municipalities across the country have actually even gone so far as they've actually removed their parking minimum requirements from new developers. And so historically, a lot of developers, that they were going to go in and build a condo or a hotel or you name it, whatever it might be, some type of residential unit, they had to build a parking lot per every 1,000 square feet, or some type of, there's a formula there, like X number of parking spaces per every 1,000 square feet. And a lot of times that created excess parking supply in any respective area where things were being built. Well, that's been removed in a lot of major cities across the country. And so what that's created is the supply demand imbalance. So parking is going away. Developers aren't building any excess. They're only building enough for what they need for their own product, not necessarily enough for transient traffic and demand drivers such as sporting events and things of that nature. And so we know that when we buy parking, it has to be in an irreplaceable location, meaning that like it can't be built again. And we know that the current use today as parking, it makes economic sense. Like the numbers have to make sense. We're not just buying a covered land play that has to carry itself. It has to make the returns that hit our metrics. But we know that the lowest use is in its current state today. Like it inevitably will be worth something more in the future, but we can ride that cash flow wave and know that no new supply is coming on the marketplace for many years, many decades to come, until inevitably, whatever year that might be, whether it's 20, 30 years, it could be a redevelopment. But we don't have to sell that asset to hit our returns. I mean, we can hit the returns by just running the cash flow model, focusing on the underlying fundamentals. I mean, the fundamentals haven't changed, at least from our standpoint. They haven't changed, right? It's got to make money today. And if it makes money today and all the data points hit to where once we've owned it for a period of time, like this is a great asset, man. Like, it's exceeded expectations. It's like, well, why sell then? Why are we going to sell if we know it's going to be very difficult and it's going to get even harder to find replacement assets?
So do you have investors come to you guys though and kind of put pressure on you to want to see you recycle that capital faster?
Well, I think it's important. That's a great question. I think it's important if you're out there raising capital for deals to make sure that you're attracting the right investor base per what your business model is, right? Yeah. And so we learned early on that the folks that are looking for that, you've got like three camps. You've got the newer, I guess, investors. I mean, if you want to, let's speak to accredited investors, because that's ultimately what we do. We do Reg D 506 Cs, and so we can only have accredited investors. You've got like the first phase, like they still have to recycle that capital, man. Like they're building wealth, and they're high income earners, or they're doing well, but maybe they got a net worth of, $1 to $3 million, but like they're not done. They're ready to take some more risks. They need to recycle that capital. They're not ready to set it and forget it. And then you got the middle camp there. Like they're doing much better than that first camp. They're not willing to take as many risks, but they still need to get that capital recycled. Maybe it's every 5 to 7 years. Yeah. And then you got that last camp. Like they're kind of like, hey, I got it. Don't want to lose it. Yeah. Don't need to get double-digit returns on an annual basis. Just buy great assets, and also don't create a tax event for me every 3 years. So unless you've got a backup plan of like you're going to be able to put that capital into something else and like literally not send a big tax bill my way, like because that camp there is what we found, and we got more pushback earlier on when we would sell assets. We got more pushback from folks saying, "Damn it." Like, great, I'm happy, but like you create another problem for me, right? You got depreciation recapture, you got capital gains. I mean, you've got all this stuff that
and one of those variables there on a mobile home park that most people don't understand is you can accelerate a lot of that depreciation up front, which is a great inroad for somebody to be attracted to that investment vehicle.
It's just heavy on the back end.
It's the best. It's hands down the best depreciation of any asset class.
Yeah.
And so if you have a high net worth individual that needs to offset that, they're like, let me in. But the moment you sell, I'm back in the same boat.
That's right. That's right. So we've really put an emphasis on that second bucket and third bucket, but primarily that third bucket of investors. Again, great assets, long-term holds. Like, just pay me my distributions every quarter consistently. Yeah. Don't create tax headaches for me every 3 years. Unless, and if you're going to do that, if you are going to sell something, make sure you got a plan. Make sure you got something else for me to put it into, right? And that becomes the challenging part as investors like us, is finding other things to put it into, especially if you're having big exits and having to deal with depreciation recapture and all that, and try to salvage that investor relationship. And so that's why we like that buy and hold model, buy for the long term. And again, they're not building new mobile home parks, they're not building new parking. And so I'm not saying we'll never sell, and I'm not saying that we don't sell, because we do sell assets. But most of the time when we sell at this point, in any respective fund, we might buy 10 to 15 properties. One thing I could promise you about a pro forma is that property is never going to, meet exactly what that pro forma state. It's either going to do better, or it's going to do worse, right? It's never going to do exactly what you've laid out on paper. And also the market, you do your due diligence. If it's a new market that you're going into, you've got general data points that you go from, and either that market's going to exceed expectations or not fully meet expectations. And so there's certain deals that we might sell that after owning for a couple of years, it's either hey, we haven't been able to expand this marketplace as much as we thought we would have. And so now we don't have enough of a presence here. We've done our value add plan in the park. Let's go ahead and sell it. Or it's a park that, while it's good, like it's draining some resources for whatever reason. Maybe it's just got more challenges, had more skeletons what we anticipated, and we're just kind of over it. Like, let's just move on. Let's move on and find a better opportunity, right? If you guys have done that, if those that are listening, if you've done enough deals, you have those stories in the back of your mind. That one deal that it took 80% of the focus, and just like, I'm tired. Like, I just want to move on. It's a good, like, we fixed it all now, but like, I'm drained. I just want to move on and kind of start fresh. Don't want to think about it anymore. And so we do sell stuff, but we like to kind of identify the cherries within our portfolio of each fund, and literally sell the other, sell the ones that for whatever reason we don't want to keep, refinance the cherries, and literally just get all the investor capital back, and then ride off into the sunset together. Ride off and share the distributions every quarter.
You maybe share a little bit about refinancing on a property and why that isn't a taxable event?
Yeah, well, it's not a sale. So a capital gains is only triggered upon a sale, and so you're not actually selling the asset. You're just putting new debt in place. So ultimately, if you go to sell that property, there is a capital gains will be paid on that entirety amount of your gain along the way, even if it's 20 years later. Which is why like the 1031 rule becomes very important if you're playing the strategy of cash out refinances for a long term. You better have a good estate plan in place. You better have a good succession plan in place for your portfolio. And so, getting ourselves around advisors that are way smarter than us and actually planning these things out, not just for our individual basis, but also for the company and for the kind of the growth plan that we have with assets, and what is the longer term plan, and how do we ensure that our investor base, as well as our families and our immediate families, are taken care of, and we're planning for them for the future.
It seems like one of the keys too that a lot of people get hung up on, the value add, that's very tangible to wrap your head around. It's sexy. You're like, oh, ARV, if we can do X, Y, Z, we can create this kind of value. This will be the windfall if we sell it. The long-term strategy requires a pretty extensive management structure in place, and the ongoing nature of that. And that is the hardest part of real estate is how to do that efficiently and how not to burn your people out on it. How to do it at a high level. So what have you guys figured out from a management perspective, especially for mobile home parks, which is different than an apartment complex?
Yeah, years ago, we self-managed all of our mobile home parks. This is back in the I guess 2011 through 2000 and call it 2016. Managed everything that we own, and realized that we got to a certain size where it's like, number one, what we're really good at is finding opportunities. But what we're not great at and what we don't love is actually managing the day-to-day of these deals. And we also weren't at that point, we weren't large enough to really justify the staffing, because like there's a couple steps back you have to take at some point in your growth. If you don't want to do it all yourself and you want to get past a certain scale, you got to be willing to actually maybe stop taking an income yourself, stop and literally start hiring staff, and probably get to a point where you're actually in the red for a period of, call it months, years, to where you're feeding the beast before you can get to a certain scale where you can actually afford that additional staffing that you need to run a vertically integrated property management company. And so we got to that pivotal moment, and we were like, it'd be great if let's just outsource this. There's a handful of groups, property management groups in the manufactured housing space. We interviewed every single one of them, went through a whole process, like a 3-month process, and identified 2 that we handed our, at that point, we had 13 mobile home parks, handed those off to, and then went on and focused on buying. And literally within like the first, 4 or 5 months, literally bought another 8 mobile home parks, almost doubled the size of the portfolio. And also at the simultaneously at the same time realized that both of these management companies that we had about 8% to the largest group and then 20% to the smaller boutique group, and they both sucked. It was absolutely horrific. It was the worst thing ever. It was way worse than what we even did fumbling through it. I mean, it was a horrific.
I thought you were going to say that it was like the best
thing
you've ever done.
We thought it would have been, and the problem was so not only did we hand them like 13 pretty much stabilized properties, but we bought 8 others that were all had different business plans, but one could argue they're all value add. They all had things that needed done to them, right? They weren't just core plus stabilized deals. And we very quickly realized that this was a nightmare. We had to build this out. We had to do it secretly, because they could simply, if they realized that we were building out a property management company, they could just literally say, okay, guys, if you're going to fire us anyway in 4 or 5 months, take it all back now, right? And we had no infrastructure in place. So we scrambled, over a period of about 5.5 months to build it out internally, secretly. And we just basically, myself and the other principal, just, put up, a few $100,000 in the coffers of our personal money, saying, hey, like we absolutely, like we are forced to hire the people now that we can't afford if we want to do this. And so number one, we stopped buying. In fact, we ended up stopped buying for like about 2 years, because we got the infrastructure built, brought the properties back in, but then we had to turn everything back around. I mean, it was a complete nightmare for like 2 years of just literally playing defensive role. And
what work did you have to kind of do to repair the damage that had been done?
Yeah, I mean, just hire the right team internally. I mean, just hire folks with property management experience. Really build out like all the SOPs. And so what we did is we actually brought in the multifamily property management companies. I feel as far as like if you want to, number one, multifamily is close enough to mobile home parks. There's more overlap than there's not. And so we basically brought in a multifamily consultant, a property management consultant that literally helps new property management companies that want to form for that, to be either a third party provider, to maybe it's for their own portfolio, but they literally come in and help all the SOPs, build them all out. And so we spent about 3 months.
Was that worth it to pay them to come in?
Yes, because they literally already have a lot of the format built out, and just it was a lot easier to modify and eliminate maybe things that weren't applicable than that to try to build it from scratch, because there's certain processes that like we didn't even know existed or should exist, right? Like we would have figured out over time, but I think just fast track the process. It wasn't perfect by any means. It was a complete disaster, and I think we did it well. I think we planned as well as we could, and we executed as precisely as one would have expected, given the circumstances. But it was still multiple steps back then at that point to then take multiple steps forward thereafter.
So there's definitely a lesson there of not like forcing yourself to recreate the wheel. So I'm sure that expedited everything.
And how much?
Well, that and myself and my other business partner, like neither one of us wanted to really. Number one, we didn't have the expertise to own the property management side. I mean, we both run parks and we both run assets, and I ran a number of my properties when I was younger, single family stuff, but like very different, completely different world than that of running a few thousand lots. It's just a completely different environment. And so, another thing we did is we just focused on hiring folks that had way more experience than we, that already had, a decade plus of experience. A lot of it was apartment related, kind of carried over. And then we had a few MH specific that we brought over that had worked for some of the bigger operators that just were kind of sick and tired of the corporatized America that, some of these larger operators turned into, and brought a lot of the, the relevant experience over and SOPs maybe that worked really well for them. And so we just brought the talent in that had already been there and done that. Again, that's not a set it and forget it either, right? Like, but bringing that talent in that already has the experience. And there's weird people in this world that really love property management. Like there's
those people are weird.
So finding those people that love that side of the business, like that was key, like focusing on that.
That's crazy. I mean, that's what blows my mind. Being an owner and an operator is that you hit this moment where you're like, I don't have everything that I need in of myself to really be successful at this level. And so literally to be successful, I have to go rely on other people who have skill sets that I don't, even though I'm the owner.
Yeah.
Did that make you feel like, I mean, were you used to that? Did that feel weird to delegate something that they were better at than you?
No,
You're the leader.
That's it. My personality, no. And I think I've always thrived in anything I've done with having a business partner of some sort. And then that business partner has always been someone that's way better at things I'm not good at. And whether it be the single family home stuff or the first couple of parks I bought with a partner, and really he was the yin to the yang. Like, so no, that's never been foreign to me. I'm not ego driven from a standpoint of like, it needs to be me. I can do it better than everyone else. In fact, I'm pretty self-aware in that way that like, I know what I'm good at and I know what I'm not good at, and also what I really don't like. And I'm not embarrassed to actually say like, I suck at that. You're way better than I. Please help me out here. Like I need help. Please bring your expertise in and do your thing. And so, and that's that way has really allowed us to even grow today. So like the last couple of years, we've had some big pivotal growth periods in our property management side to where we brought in some just top tier talent. We've got to the point again, we started hitting some ceilings and then really brought in some top tier talent from some of the other, bigger operators that we have a lot of respect for, that have been in the industry for 30, 40 years and that are really, kind of leading the charge on latest and greatest and in our industry. And so we brought a lot of players over and attracted them for, number one, again, the boutique nature, more entrepreneurial nature of our company, our size versus maybe the company they're coming from, but also profit sharing opportunities, really being able to participate in future upside and helping be more closer to the growth of the organization and feel like you've actually you're truly a part of something. You're not just another number.
Yeah. Wow. All right, we're going to jump into our smaller pockets segment. So, Kevin, go ahead and tell us about a deal that went wrong. What happened? What went wrong? And then what did you learn from it?
Yeah, no, I'll share. It's a mobile home park deal. It was one of the ones way earlier on, and it was a smaller community up in Pennsylvania. It was on
your old stomping grounds, huh?
Yeah, it was on. So it was. I forget how many spaces, maybe 50 spaces, and it was on municipal water, so that was good. But it was on septic, and septic wasn't foreign to us. We had a number of communities that were on private sewer systems. There's certain due diligence you do. You normally scope sewer lines, make sure they're not like have roots going through them, they're not broken in certain areas, and you also you test the leach field to ensure that it's actually can absorb the I'm losing my train of thought now. Whatever the name of the stuff that goes into it, right? The liquid after it goes through the septic tank.
Yeah.
And you do all these tests to ensure that it's working properly. And this was everything was working fine. We had a local company that tested everything for us, and we bought this community. And like 2 months after we bought it, we get a call from the Department of Environmental Protection in Pennsylvania.
Those phone calls are never good.
No, basically stating that we have a massive sewage field in the back of this community, and so basically it was a value add park. Lots of cleanup, just lots of family had owned it for 50 years. I mean, there was like a big trash heap in the back of the park, way back behind where the septic and all that was, just of like couches and mattresses. I mean, everything you could think of this piled back there. Well, sure enough, that's where the sewage field ended up being. And what we found out is that as we removed all this trash, we found out that the septic system was just flowing out there. I'm like, that doesn't even make sense. I mean, like we tested the whole system, and what we found at some point in time, well, number one, that the company we hired didn't thoroughly test it.
Right,
So
they did not do a
figured
good
that out.
job.
They're like,
Secondly,
my
at
snake's
some
about
point,
25 feet long.
At some point, this leach field failed. And so it no
It was
longer
just
could.
running out there.
So someone came along, probably the old owner's husband, who was no longer alive. He literally put another discharge pipe lower than the one that's supposed to go into the leach field, and literally that discharge pipe went under the ground, out this bank, and behind the pile of garbage that was back there, and literally just let all the poo flow back there. And someone obviously knew that this was happening, because this probably went on for years. But as soon as we bought it and we came in and started fixing things and cleaning things up, I still don't know who it was. One of the tenants must have called the DEP. Otherwise, they wouldn't have known, right? It had been going on for many years. I don't know how long. And it became a nightmare, because the problem was that, and we learned a lot from this deal. Number one, there was not enough additional virgin soil back where this leach field was to put a new leach field in. So there wasn't enough additional land that we could actually clear, or that was already cleared, where we could put a new leach field in. That was a problem, because you can't run a community without sewer.
So now you're looking at a modified
They
system.
were making us bring in a truck and literally like storage tanks, and then trucks that truck the stuff out. And like, it was literally, you'd have to truck it out like every 4 days, and then drive it down to the local sewage plant, and then pay money to dump it. I mean, it definitely was. It would have taken all the cash flow of the park on an annual basis. That's how expensive it was. And unfortunately, municipal sewer was nowhere close, and so there was no opportunity to tie into like municipal sewer in this scenario. And so, big learning lesson number one, if we ever buy anything with septics, there's got to be enough virgin soil around. So, because septics don't last forever,
right?
Even if they're individual ones, there's got to be enough virgin soil for us to be able to to build another leach field in the event one of them fails. So, like,
well, and just the caveat to that is, even it might work today, but if you have to, you might be grandfathered in, and there's new like requirements on what that is, and if you don't meet that. So in our area, you have to have 2.5 acres on a residential lot to have a septic. There's a lot of old homes. And so a lot of people don't meet that minimum. So now if you have to upgrade the septic, you got to do a mound system, which is a more expensive alternative. And that's on a residential application, not commercial. So it might be fine today, but do you have the option to expand into what the current zoning is?
That company that you guys had come out, how could they have not have known
there was no recourse.
That sewage was not going through the leach field?
Yeah.
That is wild.
Yeah, I again, I wish, Also, I think another case in point, well, like when you're getting tests like that done. So we actually had like we had a guy that brought us that deal, a local guy, and we gave him like a small sliver. So I guess you could say like he was an equitable partner, but he really was like sweat equity, and like he didn't know much, but he was the guy that was there when all these inspections were being done. So like not necessarily, there was an alignment of interest, but not like he didn't really even know what to look for. Like if I was there when that test was being done, I would have absolutely known that like they weren't they weren't doing the necessary like load tests on the system to ensure that was working properly. So again, just have either yourself or someone else in your team that's got construction experience, that has expertise in whatever inspections are happening, to identify what's right and what's wrong.
Yeah.
Right?
So how'd that pan out?
Not good.
The end all. What'd you do at the park?
Thankfully, that one we had the owner finance the deal. It was the wife of, it was a family that built it. The husband built it. Husband had passed away. The owner financed it. I mean, good. The good thing is that I think we only put like $100,000 down back when we bought it. And there was no backup. There really wasn't a backup plan there. And so we basically, it got to a certain point to where that JV partner we had locally, I said, hey, I got to wipe my hands clean of it. Like, I'm not asking for anything back. So we basically just walked away from the money and then let him try to work through it. And he tried to work through it for like the next year and couldn't get it sorted out. I mean, the local municipality was giving him a lot of challenges, fining him on a daily basis because we didn't have a good solution in place, but they weren't necessarily helping support finding a solution either. And we couldn't tie into local sewer. And I believe after 3 or so years, the park inevitably shut down. So unfortunately, the guy that probably called on us that wanted to, he was mad that we were cleaning up and we're gonna raise rents and things like that. He ended up losing his home.
Yeah, right.
as a result. So
that is, that's crazy.
Hey, well, that's also a good lesson in knowing when to cut your losses and don't be so stubborn that you don't want to lose money that you sink yourself. Because I'm sure that was a really hard call to just walk away from that. I'm sure that was like pretty stressful.
Yeah, and we ventured down the path because we're like, this lady, I guarantee she know, like, we talked to many attorneys, and her husband or one of the maintenance guys is the one that did that, probably at the direction of her husband, because this was a problem that had occurred many, many years prior. Yeah. And they basically didn't have a solution either. And so they created their own solution without anyone knowing. And
wow.
So, yeah, but it got to a point where, again, trying to focus on growing the business and growing and not like being stuck, and put our head in the sand and just focusing on this one thing that's not going to help us continue growing as an organization. Like, it's just like cut the losses, move on, and then focus on, bigger and better things.
Yeah. All right, Kevin, we're going to go into what we call our little nugget. Okay. So this is one practical takeaway or piece of advice that our listeners can implement to their real estate investing business. Could be something very tried and true, fundamental to the way you run your business, or very practical.
Yeah, I mean, I think just, from a practical sense, I spoke to really being hyper-focused in one specific area and just really going all in, going deep in it. And, I spoke to it as it relates to like asset classes, just really going deep and becoming the expert in whatever asset class. I see there's so much information out there nowadays. It's so easy to get pulled in a million different directions. Even as it relates, even if you say just mobile home parks as an asset, there's a ton of different business models within that business model that you can focus on. You can have a full rental model where you're bringing homes in and just renting them out. You can do creative financing solutions. You can develop new pads. You can do infill. I mean, like, there's a lot of different ways that you can make money there. But really, it's like pick one and just get hyper focused, go deep in it. And I think the same thing's applicable. I can use that same argument to, if you're out there raising capital, really going deep with your investor base, than trying to go wide. We have found that. Meaning that, like, we've got established investors that now, they were new maybe 7, 8, 9 years ago, and they've continually invested with us, reinvested with us in different funds and different deals along the way. But really getting to know them on a personal level, getting into their immediate networks, because and just really having them speak your praises and literally let them have them let you into their immediate surroundings, their friends, families, colleagues, the guys they go to church with, they play golf with, what have you, and go deeper into that respective network. Because you already got cheerleaders. You got folks that you've made very happy by giving returns, instead of like going wide where, we do advertising on Facebook. So we do both. But I can tell you that we put a primary emphasis on going deep. We do investor events where we literally just bring in existing investors and break bread together, spend time together. We do events. We always allow them to bring like a guest with them, someone that's not an existing investor. A lot of times they bring a friend, family member, what have you. And it's just we found that the ROI on that is substantially more. On top of that, it's more personal. Like, it's more fun for us. Like, I want to know that I'm doing well for for other folks that I enjoy being around as well. Like, it's a camaraderie thing, and like, we're doing this together. While we're over here getting our fingernails dirty and doing the hard work, couldn't do it without you, right? Yeah. And like, we're winning together as a team, and that feels a lot better when the folks that you're working with. And
that's
it gets a lot more difficult when you're so wide.
Their employees, then like, when that's the priority, they're going to take care of their customers. But if you bypass your employees to your customers, there's probably a culture issue there. So
that's right.
I think there's a lot there. So just in the spirit of keeping things moving, man, what's been one of the best resources in your business development?
One of the best resources. That's a great question. So my business partner and I are part of Strategic Coach, Dan Sullivan, Strategic Coach. I don't know if you guys know that. So I mean, I would say that that's really a lot. Like, it's very difficult a lot of times. We always hear the phrase of working on the business, not in the business, but it's very difficult to get away and truly work on the business unless you're very disciplined. And I feel like I'm pretty disciplined, but like Strategic Coach, we go away, every couple of months and spend a full day together, but immersed around other folks that are doing huge things. I mean, some of these guys in this group, I mean, are just, have $1 billion+ companies. And just the energy and the power of being surrounded by those folks, but also that one day that we spend working on the business and not in the business, and doing it around others that are at different growth stages of their company. Maybe they've, been there where we are at today, and they can help us kind of see past this future path that we're stuck at. And like Strategic Coach is like definitely one of many resources that allows us to get out and actually work on the business, when again it's very difficult to do. It's easy to say, but it's really difficult to do.
Well, it's kind of the analogy with the big rocks, right? You put the big rocks in first, and everything kind of funnels in around that.
That's right.
And
that's right.
What does it look like for people to follow more about your guys' success, connect with you moving forward?
Yeah, I mean, you could find me on all the social platforms. My last name is unique enough to where if you just type in, Kevin Bupp, my last name, you'll find me. I don't think
it rolls off the tongue well.
Yeah. Probably not too many other Kevin Bupps out there. But so in the social platforms, but then also, our website, we've got a good bit of resources on it. We go as far as putting up case studies of even current deals we own today, current deals that we've historically owned that we've recycled. We even provide links to, like, for example, like we have a current fund open, SCI Growth and Income Fund 4. We've only bought 3 properties in it so far, but we've got Fund 3 that we just closed out last year. Both of those funds, you can get access to all the deals that are in there. We put appraisals up. We put a snapshot of the business plan, kind of what we paid for it, what we perceive to be the future value actually after we execute on XYZ. And so there's just a lot of cool resources that we try to put up there, full transparency, and just so folks can get a better understanding what our business model is, like what is it that we do day in, day out. So.
Awesome. Well, we'll put those links in our show notes here. Man, thank you so much for coming on today and imparting your wisdom.
Yeah. Thanks, guys, for having me. You guys did a great job, and keep on doing what you're doing.
Awesome. As always, excited that you joined us for another episode of the Reinvest Podcast. Stay tuned every Tuesday for new episodes. And if you want to learn how you can use your hard-earned capital to diversify into real estate, go to our website, lv5capital.com, and shoot us a message. Move farther, reach higher, and grow deeper. We'll see you next time.